Hello and happy Tuesday, the week of Thanksgiving. So I am trusting you've got all your plans ready and intentions set up, messages to send to your loved ones. But today I want to talk to you about three topics. The first one is the traveling nurse. So the remote workers, and specifically traveling nurse, because I'm working with a lady who's currently working in California. She's a nurse. She's been a nurse traveling for over 5 years. So often it's going to be a challenge as a traveling nurse to qualify if you just start because we don't know what your hours are going to be versus if you work for a hospital or medical office. So the way you get paid is going to be very tricky. So you want to be in communication with your loan officer when you know you are going to be looking to buy your home. So this particular client currently owns a house, and she's lived in the property when she purchased it about 5 years ago. And then she decided to put it as a rental because she's traveling now, and her home, and I'm putting quotes because it's just traveling, so home is at her mom. So she has a letter stating she is rent free. Her current residence is a rental, and she has a lease and income coming in. So we're able to offset some of that payment with the lease. And I say some because there's a calculation for that. And she is also paying an Airbnb to live while she's in California doing her assignment. Now, the way that I'm structuring it right now is her rental property is being offset by her um, the mortgage is being offset by the rental income coming in. She is paying short-term housing, which we're not counting as a debt because it can stop at any point. It can be less. So we don't really have a housing expense for that. But we do have to calculate how much she's made with the previous job, but also how much she's making now. So if it does decline, we will have to do an underwriting discretion of how much the decline is. What is the average in the last 12 months, in the last 24 months? So I'm saying that to say be very upfront, checking in with your loan officer and get it to be reviewed by an underwriter to ensure that the mortgage company is going to approve the income. And once your income has been approved as a pre-qualification or pre-approval, make sure you are maintaining those hours, right? You don't want to just now let go of your assignment and think that you're going to qualify, because we'll have to update your pay stubs. So it's very tricky, but yet it's doable to buy your. Okay, so I lost my connection. I'm trusting it's picking up from where I did. Okay, so the key, if you're a traveling nurse, is you get pre-approved to make sure that you are getting your letter with verification of income approved, not by just a loan officer, but it's the person who's going to make a decision. It's going to be the underwriter. Also, while you have a pre-approval, if anything changes, do alert your loan officer, the person who is like myself upfront in communication with you to ensure that we are updating your income and continue to make the hours that we're using to qualify you. So that's the conversation I wanted to share on traveling nurse. Now, traveling nurse in person, but a different scenario within that client scenario. So she is also, like I said, she owns a home, but limited on funds to put down. And because the current residence is FHA, we'll have to, and she's buying in the same state that current house is, then we'll have to do what's called a conventional financing, putting 5% down because she's no longer a first-time home buyer, where you would normally do 3% conventional if you're a first-time home buyer. So she does have some funds, but we need to pay off some debts to be able to qualify and bring her ratios down. So what we're doing, and a lot of clients have equity in their home, rates have gone up, but the value of homes is being tremendously high where clients can access the equity. So in her case, we got about $85,000 equity access that we can use to pay off debts as well as to put as a down payment. We're not going to use all of that, but it gives her that option where she's not liquidating or depleting her savings to be able to buy the next home. So think about your home right now. If you have equity, you have a low interest rate on that property and you don't want to lose it, then think about a line of credit. That line of credit allows you to keep your low first mortgage, get a small loan behind it with a higher interest rate. That's true. It could be variable. There are some fixed rate options. But now you are keeping that current house that has a low interest rate, does have a line of credit, but you're not necessarily taking $300,000, right? Maybe 50, 100,000. That payment, both the first and the second, can be offset with the rental income. And now you move and purchase your next primary residence with 5% down or 3.5%, depending if you qualify, or minimum down or more down payments. Yes, rates are higher right now, but you'll be able to refinance this home that you are moving in and going to be your primary once the rates do go down, and you're purchasing within your budget. Keep in mind that the property that you've kept now is a rental that may be cash flowing positively for you to offset the first mortgage and the second, and even leave you some money afterwards. So think strategy when it comes to using your line of credit and investing in other real estate. I have another client who bought a home with her sister. She lives in Connecticut, but her sister is in Florida. So that property, because it's somebody else's house, and even though she's on title, is considered an investment for the one in Connecticut. Because the one in Connecticut has a greater credit score, we are doing the loan under her name. She owns a property free and clear, actually. We wanted to do a refinance. It's not really a refinance. We wanted to do a cash out, but an actual mortgage versus a line of credit because the rates are better. But unfortunately, what she's trying to get, it was going to be a high cost upfront with all the fees of mortgage versus streamlined through a line of credit. Also, her credit score wasn't high enough to allow her to do that as an investor. But my line of credit did actually approve her, and she just closed Friday. She closed on Friday, and she got her funds already because there's no time frame to receive your funds when you close on a second home or investment property. Now she's taking that money to pay off some debts, give to her sister who lives in the property. So they're splitting the funds. She's going to improve her credit score so that when the rates are better and we can offer her a better interest rate scenario, she will be doing that. So think of the line of credit as a bridging for goals that you have for 2025. It can help you consolidate debts, pay off some items that are coming or projects. Or like I mentioned before, it also can be useful if you're looking to invest in more real estate. But I think I covered all three: the traveling nurse, the HELOC, and let me tell you a little bit more about the HELOC. The HELOC is a variable interest rate, and it's usually based on prime, which is published online. You can look it up. Prime rate right now is 8%. It's a little bit more directly impacted by the Fed rates when they are lowering the rates or going up as well compared to mortgage. The payment is variable for most. I do have an option where it can be a fixed rate for a period of time based on how much you're using. So reach out to me so I can explain. But that's very useful for someone who is on an income that's fixed or salary and don't have much cushion for their budget. A line of credit is very useful for also accessing the equity and not necessarily using the full amount and making payment based on the balance that's used. It's almost like thinking of a mortgage because it's a lien on the house, but it's also like a credit card because you pay based on what you utilize. Usually you have a 5-year time frame to go back and use the line of credit to do your investment. It's perfect if you want to buy more real estate, flip properties. Use that because you can pay off the line, use it again. Okay. But after the 5th year, then you'd now have a fixed payment if there is a balance based on what's the balance, and you have 25 years to pay that off. So it is 5 years to utilize like a credit card, then it becomes more like a mortgage where you have to pay off that lien. So right now, with the fact that homes are still worth so much, we don't know yet. You can look it up. Some people would say it's about to crash. Some people are going to say it's going to be steady. I don't have a crystal ball, and I don't think you do either. So I would encourage you to look up. Actually, you can message me and I can set you up to receive the value of your home, and we can calculate how much you can access. It's not 100% of the equity that you can use. We will take the value of your home. We'll usually take 85% is really excellent credit in primary residence. But in general, you want to take the value of the home, multiply that by 80%. And then from that amount that you will get, you subtract what your current mortgage balance is. The rest is how much you could access as equity in your home. Okay. So it's very streamlined process, very easy, and very um, great option for self-employed who we don't necessarily want to show tax returns, and we're using the bank statement to show the deposit. So here we go. I just wanted to share with you some of the scenarios that I'm encountering right now with line of credits, travel, and nurse. I trust this information is valuable. Go ahead and comment any questions that you may have. Follow me or ask me anything that you would like for me to talk about and touch on when it comes to mortgage and line of credits. Thank you so much. Have a great one.